We're going live. We're going live. Oh, cool. That's one of my clients up from Auckland. That's awesome. Okay. So the spotlight is on you, Sue, and everyone will be able to see you. I'm not sure people can see me. If you guys can see me, can you give me a thumbs up as well, please? Whoever is in. Awesome. Oops, hold on. I'm talking to myself. Okay, cool. So now I don't need to hear myself. This is great. Okay, but Sue, you've got the spotlight fully on you.
Oh, thank you so much. I should have put a scarf on to hide the gowns.
You're good. You're good. Awesome. Great. So we'll start our little presentation. We'll do a bit of a chit chat. I'll open my PowerPoint as well. Oops. And then we can talk. Hold on. Share screen. There we go.
And I put lipstick on, I hope you notice.
There we go. Can you guys see my slideshow? Can you give me some heads up? Cool, awesome. All right, where is my button to start the slideshow? Don't laugh at me, always disappears. There we go, there it is. Awesome. Hello everyone, welcome back to some of you. It's been a while since I've last seen you, but welcome back to my webinar. Tonight we're gonna talk about what should you do in these uncertain times. Should you refix or float? But also we're just gonna give you a bit of a background history, what happens to the rates. Tonight I'm joined by Sue Taylor. She comes from amazing banking background, 30 years in the bank. I don't think I'm even alive that long. Okay. And Sue is gonna share a bit of her wisdom and experience through the tough times that and good times that she's seen through her banking career. So we're just going to briefly touch on what is mortgages, what type of mortgages are out there, what type of contracts, what length of contract you can have, and what would #Mark do. For those that don't know, I've got funny series on YouTube that I've done, which is #Don't Be Like Mark. So if you are in a bit of entertainment, they're very short little videos. You can send them to your friends for a bit of a laugh. Awesome. We decided to throw in some fun facts for you. But if in Scotland, if someone pays off their mortgage, they paint their front door red, which I thought was nice because it's my favorite color. So maybe that's what I'll do when I pay off my mortgage. Would you do that, Sue?
Yes, happily.
Awesome. Right. So let's discuss what is mortgage. Most of you probably already have a mortgage, so you would know, you should know, hopefully, what is mortgage. It's a legal agreement by which a bank or building society or whoever lends you the money has an interest in exchange for taking the title of your property. And you can remove that mortgage once you paid it off. Okay, Sue, take it away from here. Let us know, what is OCR?
Okay, so the OCR is a shortened version of something called the official cash rate, and it is set by the Reserve Bank of New Zealand. And they look at it 7 times a year to review what's going on. And depending on what's happening in the economy and a few other factors throughout things in New Zealand, they then decide what they need to do. And this rate defines what the banks usually will do over that period of time before the next announcement. And so you'll often see things on stuff and YouTube and things like that about the new announcement coming out tomorrow or next week or whatever, and people, economists in particular, are all excited and wondering what's going to happen. And so for now, the interest rates are going up simply because inflation's going up. And as inflation rises and costs of living rises and things like that, unfortunately, it affects our lending rates and the floating rate in particular. So of particular interest tomorrow is our budget that's going to come out. So we've got the government announcements. And so with that, we could see some really interesting things come out that may affect what the government are doing and what their plans are to perhaps pull inflation back a bit at the moment, because the Reserve Bank likes it to sit between 2 and 3%. And it was under that not that long ago, and that's why they had to move it on and make
What are
some
we sitting
changes.
now?
It's 7% at the moment or thereabouts. And so they will be looking, economists once again will be looking with bated breath to see what sort of announcements come out tomorrow in the budget that may hopefully bring back the cost of living, like food and things like that, but also might affect the interest rates. And that mightn't happen straight away, but there's a chance that they'll be looking at something to do there. And the other kind of rates we have is wholesale rates, and the wholesale rates affect our fixed loans. So the Reserve Bank sets an amount of money each bank has to hold in their reserves, and that comes from investments like term investments, also your income that goes into transactional accounts, and it is the thing that that's the money they lend out to customers to fix their or to borrow for mortgages. But they also have to keep a certain amount in the bank to show that they're a viable business. So they often have to borrow money in or buy money in from overseas wholesale banks. And that's where that governs mostly what our fixed rates are. And it also has an effect on if you break your loan, what can happen and why you might get break rates. And we'll look at that later.
Yeah, we will. And Sue, I forgot to make our little disclaimer right at the beginning. We are not the economists, so we're just sharing our views on the current situation in the market and from the waypoint and experience from what we see, but in no way form or term we are to provide any economic advice. If you are after any particular individual advice, personalized advice, please reach out to me or to any of your bankers or financial people you know. So so quick disclaimer, we are not the economists here.
Or visit your local psychic and get them to look in their crystal ball and see if they can tell us the answers.
True. I thought we will touch base on psychics and their crystal balls. Awesome. So if anyone has any questions, save them until the last moment at the end. As you know, we would do question and answers. And if you want to put them in the chat box as well, we can address them. So basically, as a summary, what I just said, we've got OCR, we've got government announcements, we've got wholesale rates. Everything affects your mortgages. So it's all connected. So don't think of yourself, you've got a mortgage and one bank and that's it. And you hidden inside the box. No, the bank rates get affected by everything that's around. All right, so what type of mortgages are out there? A lot of my clients know, we discussed this when we sit down to do your structure. There are fixed, there are floating, there are revolving credits, and there are reverse mortgages. Normally, reverse mortgages won't apply to majority of you here because it's usually for people above 60, 65 years of age. And this is where you get a reverse on your home that's usually already paid off from the mortgage. So the three common ones that would apply to you normally, to normal John and Mary, is fixed, floating, and revolving. All right. Sue, do you want to talk briefly about any of these loans?
I think for most people in general, the floating loan and the fixed loans are the ones you're going to look at. Revolving credit is like a huge overdraft stuck onto your ordinary transactional account, and you mix your pay and your savings and everything in there to offset your mortgage, but you're only paying interest on it, so your principal is not being paid down, and you need to have a lot of disposable income for it to be a really good product for you. But floating and fixed are great, and it's quite good to have a mix of them. And you can do them over different terms, like from anything from 5 to 30. Typically, when you first have a mortgage, it's usually over 30 years. I'm going to cough, so can you?
Okay, I can take over, no problem. So for a lot of clients, especially in these times, what we are recommending, what I am recommending, because I'm qualified to provide some advice on your loans, is to try to start splitting your loans. So not just have one loan over 1 year, but maybe have several loans split into several things. And that was a case about 4 years ago when I first started as an advisor. It was very popular back then. And then we sort of moved on to just fixing one year on 1 year on 1 year, because the rates were going down and a lot of people were winning from that. But now it looks like we just need to go back into structuring your loans into several terms. All right. There you go. There's another inspirational quote for you guys. So the way to get started is to quit talking and begin doing. Now, your agreement with the bank. So since the economic cycle is unpredictable, the banks have created shorter contracts, which constantly discussed on the news. So we know that you can fix from 6 months to 5 years. A couple of years ago, I think maybe about 5 years ago now, TSB came out with a great idea. Sub, really? I'm so sorry. The cat decided to join the talk. If it's not the kids, it's the cat. I'm so sorry, guys. Right. So 5 years ago, I think TSB came out and took a punt and decided to do 10-year mortgages. And at that point, maybe it was a great idea, and they were offering rates around 7% because everyone thought the rate's going to continue to go up. A lot of people jumped on that boat and actually fixed their loans for 10 years at 7 or 8%. However, a couple of years ago, as the rates started to go down with the pandemic, because pandemic came out of blue, it came out of nowhere, nobody expected that, and the rates started crashing. I had to save a few clients from those loans, and they had massive break fees. They had about 30 to 40,000 break fees to get out of a 10-year mortgage and move on to 1-year loans. So what would Mark do? Let's say we've got, some of you are here, you've got mortgages, and you could be everyday people employed with stable income, and you could have a combo of products. So you could have a fixed loan and a floating, and you could probably start your loan with a 30-year mortgage. And normally, Sue and I laughed about it today, that Mark will go out and probably buy a boat throughout his life with some spare cash or borrow more against the house. Now, if Mark was self-employed, he would probably have a combo of different lenders. He will have houses across multiple lenders to spread the risk. And he will also probably go for shorter terms, and he'll do floating and offsetting, especially offsetting, because if he's self-employed, he has a lot of cash flow that comes in and goes that he can just park there, especially for his tax money that he needs to pay at the end of the year. For offsetting product will work fantastic for him. And he can take that money back and reinvest into the business growth. What are your views, Sue, on this scenarios?
I think it's good to try and, I guess, mix and match and hope that you can get the right mix of fixed and floating. And that may mean splitting your fixed loans into a couple of different loans as well, to try and see if you can, I guess, beat the market, stay on ahead of the interest rates, and have things coming due at different times, so that if the interest rates have gone up or dropped down or whatever, each one that comes due 1, 2, 3 years, you'll win with at least one of those time frames, and hopefully do okay out of the others. But that's why it's important to look at the terms that you want to lock your loan in for. And I guess with the fix, that's fixed. And then with floating, sometimes it's good to have a portion floating, and you can, maybe that's your loan that we call an offset loan. And with that, you can offset the interest you would be paying on that loan against credit funds that sit in a transactional account or an investment.
Yeah, absolutely. So let's look at some scenarios briefly. I mean, remember, this presentation is just to give you a brief overview, what are your options out there. And if you do want personalized advice, do come back to us or whoever you want to go to. So one of the first scenarios I've done, and you can go and do it yourself, play with your own numbers. There are lots of calculators out there. My favorite one, not being biased here, but because I used to work at ASB Bank, I love using the ASB calculator because you can do loans comparison side by side, and you can see immediately what you could be potentially saving yourself. So one of the first scenarios we've done is, let's take a loan of 500K, current floating rate is 5.35, and comparison if you're going to fix it for 4.49. So basically the downside here, if you left everything on floating, as the OCR changes that we just discussed about, the floating rate may go up. And therefore, you won't be paying 5.35, you'll be at 6, 7, 8%, who knows where it will end up. Versus if you fixed it at lower rate, you know what your monthly repayments, it's not going to change for that entire year. The downside, you can't make any extra repayments if you wanted to. So just something to think about. But hey, you know, the system thinks that if you had this loan for over 30 years at this rate, in comparison to this rate, you could be saving yourself 94K in interest. So just something to think about and compare. Now, scenario 2, if we kept one on floating, let's say one at 5.35, the other option you could have, you could also split your loan. You could split it into 2 parts, and you could go, let's say 1 year, and I just did randomly for 3 years, just to spread your risk. And remember, we've got the election coming up in a couple of years' time, right? So who knows what's going to happen in 2 years' time, and by the time the government comes in, maybe they'll do something. So in 3 years' time, when you come out from that rate, maybe life will be better. We don't know. But if you did that, then you're looking at, you're still saving approximately $35,000. That's what the system thinks. And you can also look at what your monthly repayments are versus the other one. Now, this is scenario C. Again, I've just left one on floating, and what I've done was the other one, just to give you another comparison, is if you did your loan over 25 years. So basically for an extra takeaway a week, which is about $55 here in this comparison scenario, you're saving yourself 5 years off your mortgage. So that's another thing I would highly recommend to my clients to do, is that if you're able to, try to increase your repayments. Even $50 a week, $20 a week, that's all going to make a huge difference to the end picture of your loan. Of course, some people just rely on capital gains and they think, well, in 5 years' time, I'll still sell my property and I'll move on. Then this doesn't really matter to you. If the cash flow matters, then leave the loan on 30 years. But if the cash flow doesn't matter, and if you want to try to reduce your debt as soon as possible, then try to increase your repayments. $50 a week makes a 5-year difference. There you go. Sue, what have you got to add?
Absolutely. So what we're not saying that you go and get a 25-year term on your mortgage. You leave your mortgage at 30 years because if something happens down the track and you have to push it back out again, you might not meet the servicing requirements. So you leave it on 30 years, but you ask us to calculate how much extra you have to pay on your mortgage repayments to pull it down to 25 years or 20 years or whatever. And if you think you can afford it, we set the repayments there, and that will take that time frame off your loan. And it, as Zebunisso said, $50 a week takes 5 years off your mortgage. So if you can afford it, you know, and that's a takeaway really for most of our families a week.
Then, for those that are smoking, good incentive to stop smoking.
but there's those sorts of things, you know, if you drink 3 or 4 coffees in a day that you pay for, you know, have 2 instead and put the extra money on the mortgage, because, you know, if you're chunking 5 years off just by paying an extra 50, you will get your mortgage paid off more quickly. And that's the aim for everybody who has owner occupied in particular properties.
Yeah, absolutely. So just remember, you know, if you do want some personalized calculations, go on those websites, play around with it, and you should be able to see what it looks like. So for now, what I'm thinking is the good plan of attack is try to spread your risks, maybe break down your mortgage into several parts. Some banks let you do it without fees. Some banks may charge you fees for it because they have to redocument the loan. So just, you know, look what's out there. Don't just settle for one recipe that fits all. It doesn't. And especially if you're sitting out there on different forums, reading different information, who's doing what, it may get very confusing. Yeah, so try to find your own recipe, what works for you. There you go. That's exactly what I just said. I'm good. See, I don't even have to read my notes. It just came out. So let's make it a bit more interactive. Let's try to answer some questions. I'm sure people have questions here and there. And we'll just bring it
Where's the captain offset mortgages?
Oops, where do I go? Right, chats. What is the difference between floating and revolving? All right, Sue, take it away. What's the difference?
So a floating loan is a separate loan, like your fixed loans are, and so it's not attached to your transactional everyday account. And different banks have slightly different rules around and what you can do with your floating loans. But at Westpac, where I used to work, you could, if you made more payments on your floating loan than necessary, you could redraw that facility. So a lot of people have it as just a small facility that they can use to do renovations or buy a car or go on holiday or whatever. But it is generally a principal and interest loan. So you are paying the loan down in fortnightly or monthly increments, depending how you have your loan. A revolving credit facility is an interest-only facility. So once again, the bank I worked at had a non-reducing one, so the limit never changed and the debt never went down because you just paid interest. But we also had a facility for those people who wanted to pay the loan off, so it still came down on a fortnightly or monthly basis based on what it would be if they paid principal and interest payments. So you can get it paid off, but you have to be focused to pay off a revolving credit facility, and you have to have extra disposable cash, and it should have a credit card that works alongside with it. So with revolving credit, the idea is that you have your debt sitting on there, you pay all your bills that you can possibly pay out of a credit card, which you then pay off in full every month before interest on the credit card is due from the revolving credit. But because you haven't been spending and paying your bills out the revolving credit, you're saving interest in both places. So it can be a great product for those who have got the ability to use it. But for most first home buyers, probably it's generally just going to be a mix of fixed loans and maybe a small floating portion that they can throw a bonus into if they get paid those, or get an inheritance or a gift or something like that, because there are ramifications if you break a fixed loan.
Exactly. We've got a question coming, Sue. What is the highest interest rate that you're expecting and when? Get out your crystal ball. Come on.
That is crystal ball stuff, and we have no idea. I hope that we never go back to the days of my parents, who actually had a first mortgage at one place and a second mortgage at another lender, and one was 23% and their second mortgage was 19%. And I would hope to think we never see those days again, and we probably shouldn't, but we have no idea. But I don't expect them to look like that anywhere in the future. But as we said, we're not economists. However, at the moment, the rates are volatile, and the OCR is going up by about 25 or 50. They're suggesting a 50 point basis point increase at the next one, and then probably dropping back to 2.5 after that. But that means that the floating rates are going to be affected while that happens. And I guess it won't, and the wholesale rates are affected by all sorts of things that can happen around the world and in New Zealand. So disasters within New Zealand, natural disasters like droughts and earthquakes and flooding and stuff like that. The government has to put things in place to help people, and then inflation drops and rates drop. And then things like Trump and Putin and wars and missiles going between, North Korea and things like that. That affects the wholesale rates as well, and they can become quite volatile. But also when they have disasters around the world and stuff like that, their rates will drop as well. So there's no absolute certainty about what's going to happen with fixed or floating rates. And that's why neither Zebunisso or I are very keen on people fixing for the long term, because you're taking a big punt. Maybe if you did it 2 years ago when you could get a 5-year term for 2.5%, that would be fabulous. But, you're fixing at the moment for over 5, I think, thereauabouts, for a 5-year term. And that's a big punt, because if something happens in the next year or so, all we had, Kaikoura earthquake had a huge effect, and the rates just plummeted. So you need to think very carefully, but each person or each family has reasons why they might want a fixed loan. If you're a first home buyer and got a couple of children and 1 or 2 of you working, you need to think carefully about your budget and what payments you can have and the certainty you might want. So you might want a longer term, but I think 5 years is a very long time because lots of things can happen.
It's a very long time, especially if you're looking to sell a house anytime
Yes.
soon or move countries. Yeah, probably not a good idea to fix for long term. But I mean, my expectations, I always go by what the banks are doing in terms of test rates. So at the moment, our test rates are heading towards 7.5%. They were about 6% a year ago. So the banks were hoping probably it's not going to go more than 6%. Now we're heading towards 7.5. So I assume the banks think there is still a bit of movement that could happen, but hopefully it's not going to go more than 6.5%. That's my expectations. And that you're expecting and when? Yeah, when? As you said, because of each time they announce OCR, they usually a bit of a hike. So every 3-4 months, Sue? How many?
7 weeks.
Every 7 weeks.
Yeah, every 7 weeks it's reviewed.
Yeah, there you go.
Or 7 times a year, whatever that is.
7 times a year, yeah. Now, yeah, thanks. Let's hope it won't go more than 7.5. I really hope it won't, because it's going to hurt a lot of people. And I mean, you know, back in Sue's parents' days, even though the mortgages were 20%, the mortgages were probably around 100K max.
Yeah, max, not even that probably.
Maybe. Yeah, so it wasn't too bad to be making those repayments, but I mean the incomes weren't as high either. However, now we're seeing more and more people borrowing close to $1 million. A lot of people borrowed between $500,000 to $1 million, really, and that's going to hurt a lot of people. If we're going to keep heading up, there's going to be a lot of mortgagee sales and people just not being able to afford to live where they are. So yeah, hopefully the government will do something about it. Especially Labour can feel the hit that people are getting a bit angry maybe, and National will do something. So Labour might change. Maybe Jacinda is watching my video tonight and she'll probably change her mind on what to do. Maybe her mortgage is coming up for renewal. Who knows? Unless she fixed for 5 years. Hopefully she's not watching this video. Right. So you discussed a bit about offset. Can you tell me more about this product and who qualifies for it? So offset mortgages, we did touch on it. So who qualifies for it? People that are self-employed, probably. People that are expecting big inheritance, you said. People with big incomes.
People who've still got savings in the bank as well as a mortgage. So it's just about having funds available to offset against the interest rate. So if you don't have the ability and don't think you will in the near future, then an offset mortgage doesn't help you. Paying $50 more probably on your fixed loan will achieve a similar outcome. And it doesn't mean, and you don't have to have the savings sitting there. So I think that the main thing you should be doing is everyone needs to, particularly fixed loans, you need to consider your goals and your individual circumstances and what your life's going to look like, perhaps that you know of, because we don't always know these things, for the next 1 to 5 years. And that's when you talk to Zebunisso, who can give the advice around if this is what your circumstances and what you think you are going to be like for the next 2 to 3 or 4 or 5 years, this is what I recommend you do, because she has the knowledge the same as we do around seeing lots of different people with lots of scenarios, and one does not fit all in mortgage lending. And so it is about your individual needs. Yeah,
absolutely. Awesome. So we're going to start wrapping it up, guys. You've been listening to us for the past half an hour. You've done well and you stayed with us. If there are any burning questions, please ask them. If there are any topics you want me to touch in the future, also let me know, because obviously I do this for you. I try to share my knowledge and bring in people that will be interested of you. So yeah, so if there's anything that you guys want us to touch on in the future, please let me know. More than happy to create some topics and bring in some guest speakers. We're getting some thank yous, Sue, but it's coming direct to me, so you're probably not going to be able to.
Yeah, I can't see it.
Yeah, because all the chats are coming direct to me for some reason. second tier lenders. Okay, we can touch back on second tier lenders. Cool. So yeah, hopefully this was a bit of informative. As I said, it was meant to be general, fixed or float, all sorts of things you can do right now. The economy is unstable, the rates are volatile, but what you can do is you can control your own situation. And that's what I always recommend to people. If you can control something, control it. Don't let others control it for you. And if you're unsure, reach out to the specialists, to the professionals, and we should be able to help you out and set a clear path. So thank you so much. Thank you so much, Sue, for coming along and sharing your knowledge. It's very good to have you. And have a fantastic night, everyone.